The brain is a complex organ. It's so complex that when we face a problem that we can't wrap our heads around, it will try to dumb it down to our level by constructing a model of it. A mental model. The more input you take from different disciplines to solve a problem, the more viable and useful is your thinking. The quality of your thinking is directly affected by the amount of different models you have in your head. Famous investor Charlie Mungers refers to this as the latticework of mental models. The book Investing, the Last Liberal Art tries to show us the use that different disciplines can have on your mental models and how they can be applied to investing. That being said, I think there's only one formula in the book, and this is a fairly unique way of approaching the investing topic. A mental model isn't enough though. We must also learn to find ways to describe the real world, and this is done through finding metaphors. A metaphor allows us to convey meaning using out-of-the-ordinary language. Charlie Mungers spends a lot of time focusing on different disciplines, apart from business, because it allows him to unite models from them. Then, using the united latticework of mental models, he achieves a superior investment result. The book covers several disciplines. They are the following: physics, biology, social studies, psychology, philosophy, literature, and mathematics. I intend to give a brief overview of the general ideas in each discipline. So let's start with physics. Physics is the science that studies how the universe works, looking at the interaction between matter and energy. The main lesson that we can draw from physics is that of equilibrium. Equilibrium is defined as a state of balance between opposing forces, powers, or influences. In economics, equilibrium can be expressed by looking at the interplay between supply and demand. This is what's known as a static equilibrium, an equilibrium at rest. An equilibrium at rest, in any market, would imply that everyone exchanges at the perfect price, with everyone being rational and that no one has an edge or strategy that isn't already priced in. This way of thinking is rightly being questioned with systems that aren't at rest, known as complex adaptive system. A complex adaptive system always strives for a new equilibrium. Agents and players change their behavior depending on what other agents and players in the system are doing, almost in an evolutionary way. Great segue. This brings us to the next discipline, biology. Seeing the economy and companies from a biological evolutionary lens does not require too much thought, where companies need to adapt and change or they won't survive. Survival of the fittest. We all know the story of Darwin and the beagle. This evolutionary view has inspired a lot of ideas like creative destruction from Schumpeter. Even financial strategies have evolved in a way that is similar to biology, with strategies changing over time. In the 1930s and 40s, the discount to hard book value strategy was popular. Then, after the Second World War, the major strategy that dominated finance was the dividend model. And by the 1960s, a third strategy appeared. Investors exchanged stock paying high dividends for companies that were expected to grow their earnings at a high rate. In the 80s, Warren Buffett stressed and popularized the need to focus on cash flows. And today, we can see that cash return on invested capital is emerging as the fifth new strategy. When a strategy becomes the dominant one and more capital flows to it, the strategy becomes less profitable. We've seen this in other things. And the evolution starts anew. As Doyne Farmer says, the long-term evolution of the market can be studied in the terms of flows of money. Social science is the next discipline. Social science is the study of how people function in society and tries to understand group behavior. Social science has a bad reputation of not being a real science. It's historically dealt with the subjective and the unpredictable nature of humans. With the increase of computing power, though, this is changing and is starting to become more of a science than before. As mentioned previously, social science is the study of how people function in groups and societies and how these groups behave. Social scientists have agreed that social systems are the following: self-organizing and self-reinforcing and adaptable. Both of these things can be seen in the markets, where economic cycles are part caused by self-reinforcing effects. The bull market, as a self-reinforcing process, leads to greater construction and manufacturing until the return on investment begins to decline, at which point an economic slump begins. The adaptable part is embedded in what's known as the theory of emergence. This says that the sum of the whole is greater than the sum of the parts. The theory of emergence also says that self-organizing systems have three distinct characteristics. First, behavior occurs by a simple connected local processor. In social system, this processor is the individual. Second, a solution arises from the diversity of the individual inputs. Third, the functionality or robustness of the system is far greater than any one of the individual processors. To put this into what we care about, the stock market. It is more robust when it's made of a diverse group of agents with varying level of intelligence and strategies. When this breaks down and people start following booms, fads, fashions without thinking, it leads to an unstable market and crashes. The next discipline is psychology. The way something is framed and described to us can make us take irrational decisions, like the following. In one experiment, a group of people were asked about how to do a public health program for 600 people. In the first case, people were asked to choose between A, saving 200 lives for sure, or B, 1/3 chance of saving 600 lives with 2/3 chance saving none. A was overwhelmingly chosen here. The second case, A, 400 people dying for sure, or B, 2/3 chance of 600 people dying, with 1/3 chance of no one dying. Here, people chose B. When quickly doing the maths on this, we can see that the two versions are identical, just framed differently. So this tells us that people are generally risk-averse when making a decision that offers a hope of gain, but risk-seeking when making a decision that will lead to certain loss. Individuals are loss-averse. The conductors of the experiment managed to prove mathematically that individuals regret losses more than they welcome gains of the exact same size. 2 to 2 1/2 more, in fact. This loss aversion makes us not see the long term, but rather focus on the short term. By considering our investments less often, we can focus more on the long term. The optimal frequency that we should look at our investments to overcome this is stated in the book as 1 year. I know that I look at my portfolio more than that. What I found quite interesting as well were studies and books written on the effects of the internet on investments. They claim mostly that the internet can lead to an illusion of knowledge, making us more confident than we really should be. Emotions related to the stock market and the risk tolerance is highly related. When the market is doing well, people become much braver in their own eyes and they eagerly accept more risk. But when the market goes down, they usually rush for the door. When dealing with investments and your portfolio, you need to be mindful of the decisions that we're taking and what's influenced them. Don't listen to the noise of the market. Charlie Mungers warns investors about taking mental shortcuts, because they're easily misled and prone to miscalculations. This brings us to the next discipline, philosophy. Philosophy is arguably the broadest subject there is, so some narrowing down is needed. Philosophy can widely be split into 3 areas. Metaphysics, this describes the ideas that are independent from space and time, like God and the afterlife. Beauty, which relates to the 3 areas of aesthetics, ethics, and politics. And epistemology, which studies the theory of knowledge. This chapter in the book focuses only on epistemology. An epistemological study asks, how can we increase our understanding of something? As people are often driven by storytelling and narratives, they can often be used to hide important information and skew our interpretation of the facts. If the description is faulty, the explanation is likely wrong. The philosophy of pragmatism helps us to navigate descriptions and faulty explanations. And quoting the book, to state the matter as simply as possible, pragmatism holds that truth and rightness are defined by their practical outcomes. An idea or an action is true and real and good if it makes a meaningful difference. So we, as investors, should not be fixated by one idea, one ratio or strategy, but the successful investor should enthusiastically examine every issue from every possible angle to get the best possible description of what's going on. Basically, critical thinking. The next discipline to get a review is literature. Reading is a great way to get an understanding from masters that came before us. This doesn't just come from books though, but also newspapers, articles, financial statements, and so on. But how should you actually absorb the knowledge? One way to absorb a book is outlined by Mortimer Adler's book, How to Read a Book. Adler says that when we read a theoretical book, we must keep 4 fundamental questions in our mind. What is the book about as whole? What is being said in detail? Is the book true in part or whole? What of it? There's also benefits in reading fiction as well. The author speaks of detective books and how to put together a puzzle. Fiction books convey an experience. However, that experience is highly subjective and therefore impossible to analyze generally. I personally enjoy sci-fi and the concept of taking an idea and building a world around it. The final discipline dealt in the book is mathematics. Not surprisingly, mathematics is important in the field of investing. This chapter looks at calculating cash flow, discounts, probability theory, variances, regression to the mean, and uncertainty and risk. I hope you're all familiar with the discounted cash flows, where the intrinsic value of the business is calculated by discounted value of future cash flows against the bond rates. The problem is that we can't be sure of the future cash flows the company generate, so probabilities of different outcomes come into play. Using a Bayesian analysis, where new data and information is steadily incorporated into the original assumption to create a better and improved one. The model is sometimes also referred to as the decision tree theory, which helps paint a picture of what it is. The Kelly optimization model is also considered. It provides a way to determine mathematically the optimal size of a series of bets, so you would maximize the growth rate of your portfolio over time. And it's based on the simple idea that if you know the probability of success, you bet the fraction of your bankroll that maximizes the growth rate. It's expressed as the formula 2p minus 1 equals x. This is the only formula in the book, where 2 times the probability of winning minus 1 equals the percentage of one's bankroll that should be bet. The problem with this model, though, is that it assumes that you have an infinite bankroll and an infinite amount of time. So instead of using the entire bankroll, half or fractional carries are advised, i.e. divide by 2 or more. Variance can easily be studied by looking at sideways markets, something that we'll probably start to experience again. In a sideways market, there are still very attractive opportunities. Just don't invest in the latest ETF trends. There is a difference between the average performance of the stock market and the individual performance of stocks. While not a discipline, the one where we actually put everything together is decision making. There's been a lot of different studies on the different ways of thinking. The general idea and the accepted idea now is that there are 2 different ways to tackle a problem. One is through intuition, quick and associative, system 1 thinking. The other one is through reason, slow and rule-governed, system 2 thinking. In the famous book, Thinking, Fast and Slow, talks about this. It says that system 2 thinking can be tiresome, and if we're prone to distractions and continuous challenges, we're likely to yield to temptation and use system 1 thinking. Additionally, if system 2 thinking is not armed with sufficient information and models, it might just not be as good, and we might just as well be using system 1 thinking. So, in order to solve investing problems, we need a well-armed system 2 thinking. And this can be built up from the models used in the different disciplines. These models can then be used with metaphors to link back to the investing world. Charlie Mungers says, it turns out that the truly big ideas in each discipline, learned only in essence, carry the most of the freight. And one of the principal goals stated in the book is to give you a broader explanation of how markets behave, and in the process help you make better investment decisions. And we've learned that our failures to explain are caused by our failures to describe. Some closing remarks from my side. I really enjoyed the book, and I found it quite a novel way to write about investing. It makes you think about it in different ways and disciplines. The reading list in the book is extensive, and it includes a list to the prestigious St. John's College reading list. I suggest you Google that if you're ever looking for a new book to read. Thank you for listening, and I hope you enjoyed this video.